So let's continue with our discussion here, talking about how taxes influence the value of the company. So again, if investors could buy these shares for 15 immediately, then they could sell them immediately after at a higher price. The question is, wouldn't that represent an arbitrage opportunity? And realistically, that immediate rise from 300 to 335, is that something that they actually can take advantage of? So with 20 million shares outstanding, again, the share price is actually going to raise to about $16.75. That's what the 20 million shares were worth. So again, if you think about what should we actually offer them, if we could offer them the $16.75, in the end we would essentially break even from our purchase. So again, with this repurchase price, just to work our way through the numbers, those people that tendered their shares would gain $1.75. 16.75 minus the 15. The benefit of the interest tax shield goes to all 20 million of the original shares outstanding for a total benefit of 35 million. $1.75 times 20 million, that's our 35 million. So when when securities are fairly priced, the original shareholders of a firm capture the full benefit of the interest tax shield from an increase in leverage. So again, the original shareholders are all going to gain based on this tax shield. The next step then is say, well, wait a minute, there's something more than corporate taxes. What about personal taxes? The cash flows to investors are going to be taxed typically twice. Once at the corporate level and then once again at the dividend level. For individuals, interest payments are received from debtor taxed as income, obviously, but ordinary income and equity investors pay two kinds of taxes: taxes on dividends and taxes on capital gains. So the amount of money an investor is going to pay depends on the cash flows they're going to receive after all the taxes have ultimately been paid. So personal taxes reduce the cash flows to investors. So they're going to offset some of this benefit that ultimately arises from the increase in leverage. So we have what looks like a fairly complicated formula where we have three different taxes now. T sub I is the tax on debt, T sub C is the tax on corporate taxes, and T sub E is the tax on equity. The algebraic simplification of this, although it doesn't look all that simple, is this formula over here. So what I want us to just briefly think about is what happens if T sub E, the tax to equity shareholders, was equal to the tax to debtors. What if the taxes on shares was the same as taxes on debt? These would obviously would eliminate, right? They would zero out, if you will, or average out. Then we'd have 1 minus 1 minus TC. Now this is the tax shield, so this is all multiplied by D. So you have 1 minus 1 minus TC times D, which that was ultimately our, what do you have if there's corporate taxes? But what happens if the numerator, the product of the numerator, equals the denominator? Then these are ultimately what? This equals 1. So now we're back to the original Modigliani and Miller case where there's no increase or change in value when the corporation issues leverage. So what does that look like on a picture on the graph? What we'll see is, as I mentioned earlier, that taxes, personal taxes, are going to diminish some of the value that's gained from corporate taxation. So the real amount of value gained from borrowing is somewhere between the two extremes of corporate taxes only and no taxes. So the real world obviously then is kind of is in between those. So do firms prefer debt? So when firms raise new capital from investors, primarily they do so with debt. So most years the aggregate amount of equity issues is negative. In other words, people or corporations are typically rebuying shares more than they are issuing shares. While firms seem to prefer debt when they're raising external funds, that's not all the investment that is actually gathered, right? Not all investment is externally generated. Retained earnings, the profits of the company, are going to create a substantial amount of the potential funds that can be gathered from outside. So it's possible that if a company was profitable enough and had the cash flow to support it, they would never have to borrow at all. They could use only the profits of the company. Now, you might say, well, why wouldn't companies that could do that, why wouldn't they do that? Well, quite frankly, there are some benefits that ultimately go to the shareholders. That is, the taxes on dividends and capital gains is much less than the taxes on interest. So they would rather pay lower taxes on dividends and be able to reap some of the rewards that are found in the profits of the company. The use of debt is going to vary a lot from industry to industry. No industry is going to be the same. No country is going to be the same. But there will be some consistencies, though. Those companies that are more technology driven, biotechnology, the computer industry, pharmaceuticals, etc., all of those companies are going to carry very little debt. The other industries, right, the ones that seem to be more stable in your financial firms, they're going to typically have higher leverage ratios. A lot of that has to do with the inherent risk of growth. So the optimal level of leverage from a tax saving perspective is essentially earnings before interest and taxes. You want to borrow enough so that interest exactly equals EBIT. If interest equals EBIT, you have no taxable income. And obviously with no taxable income, all of those benefits, all the benefits stay with the firm. Now the challenge is it's very difficult for companies to predict exactly what their EBIT is going to be. So they may not want to get that close to EBIT, but they do want to borrow to get approaching EBIT. So the tax savings falls once the risk of having negative profitability starts to become a little bit more apparent. So we do have to worry a little bit about the using the word optimal, because the optimal amount of debt is very risky and very difficult to talk about. So what do we need to know about how growth affects this leverage ratio? Well, if interest obviously is the interest rate times debt, we want that to be less than or equal to EBIT. Or in other words, we could say let's take the debt to make sure that that amount is less than or equal to EBIT divided by the cost of debt. This way, obviously, we're setting a precedent of how much debt we obviously can have. So can growth, right, to avoid this excess interest from a firm with positive earnings should have a level of debt so that the interest payments are below its expected taxable earnings. So again, we don't want to grow so fast that we exceed the EBIT. So we want to monitor that ratio to make sure we don't grow too fast. Again, from a tax perspective, the optimal level of debt is proportional to its earnings. However, the value of equity is going to depend on the growth rate of earnings, right? That growth rate is what ultimately drives the value of the firm. The growth rate of earnings is ultimately invested, right? Some of it is distributed as dividends. Some of it is paid out as kept as retained earnings. Those retained earnings are going to grow and ultimately increase the ultimate value of the company. And there are a lot of other tax shields, right? There are tax shields on depreciation, investment tax credits. There could be carry forwards if you had previous losses. So to the extent that a company has tax shields, its taxable earnings can be reduced, and then it can rely a little bit less heavily on that interest tax shield. So we can offset some of the necessity for having a lot of debt to increase value if we have these other tax shields that can help us approach and get close to EBIT. A couple important patterns again. Companies have used debt to shield a greater percentage of their earnings from taxes in more recent years. So some companies that have not had debt have been increasing debt. Some that have had debt are actually looking to increase to take a little bit of advantage of that tax shield. Firms have far less leverage than our analysis of the interest tax shield would predict, though. So companies do seem to be borrowing more. However, they're still not approaching what you would expect to be the optimal amount of debt that a company might have. So on average, it appears companies are under at leverage. It's hard to accept that everybody is acting suboptimally, right? It's hard to imagine that everybody is doing this thing wrong. There's got to be something more. There's something must be missing from the story if companies are not acting in an optimal way. And the thing that's missing is the concept of financial distress, right? If bankruptcy is costly, and it is, then they're going to offset any of the tax advantages that come from debt financing. So in the next chapter, chapter 16, we will discuss bankruptcy, financial distress, and ultimately how does this impact the company. We'll also look at some different theories as to why companies actually do what they do. They might not necessarily strictly follow the theory in place, which is, there's an optimal amount of debt that they should have. There might be something else at play that helps management make some decisions.